Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 24th, and the market mood today is basically, I would like certainty. And the universe replied, best I can do is vibes.
Vibes? I opened my brokerage app and it looked like a haunted house tour. Every door I clicked said, boo, tariffs.
Today's menu. 1. Tariff uncertainty and why it keeps punching markets in the face. 2. Nvidia's Q4 earnings preview, high stakes for the entire AI trade. 3. Oil near a 7-month high as traders watch U.S Iran talks. And we'll close with the Fed, Goolsby signaling not yet on rate cuts.
So it's a chill episode about global trade policy, semiconductor margins, Middle East geopolitics, and interest rates. Cool. Normal. Very sip tea and relax.
Story 1. Tariffs are back in the headlines. The feed points to a new global tariff at 10%, plus a 150-day clock, meaning policy could shift again. And markets hate that kind of rolling uncertainty.
A 150-day clock sounds like a gym challenge. In 150 days, you too can transform your supply chain into a stress rash.
Tariffs are like a surprise service fee added after you already ordered dinner. Companies either pay it, raise prices, or squeeze suppliers and workers. None of those options are free.
So consumers get the optional fee that is not optional. Love that for us. Do I at least get loyalty points for funding international trade drama?
Why markets react fast? Earnings estimates. If you slap a 10% cost on a chunk of imports, analysts start trimming profit margins, especially for retailers, manufacturers, and any business with global components.
The spreadsheet people get cranky, and then my index fund catches strays.
Actionable take for normal people. In tariff headlines, don't trade the panic. Do a quick exposure check. If your portfolio is heavy in import-sensitive sectors, balance it with businesses that have pricing power or more domestic revenue.
Okay, speaking of pricing power, let's talk about the company that sells the shovels in the AI gold rush, Nvidia. Everyone's acting like earnings day is the Super Bowl, but for accountants.
The item in the feed, Nvidia Q4 earnings preview, high stakes for the AI standard bearer. The key point, the market focus is shifting from simple beat the quarter to sustainability, production ramp of Blackwell, hyperscaler spending digestion, and whether gross margins can stay around the mid-70% range mentioned in the preview.
Mid-70% gross margin is so high it feels illegal. Like, sir, step away from the cash register and put your hands where the regulators can see them.
Simple version, gross margin is basically how much of each sales dollar you keep after making the product. Imagine selling lemonade. If lemons and cups cost you 25 cents and you sell for $1, your gross margin is 75%. Nvidia's ingredients are complex, but the concept is the same.
So Wall Street is asking, are we still selling premium lemonade? Or are we about to get store-brand AI juice with a coupon?
Exactly. And the preview also flags production ramp for Blackwell. That matters, because if supply can't meet demand, revenue gets delayed. If supply suddenly catches up while customers pause spending, the narrative flips from shortage to, digestion.
Digestion is such a polite word. It's like hyperscalers are at an AI buffet, going, I can't buy another GPU. I'm unbuttoning my jeans.
Story 3. Oil is near a 7-month high as traders await U.S Iran talks, with the headline noting the preference for diplomacy but warning of consequences if no deal is reached. Markets are pricing the probability of supply disruption versus relief.
Oil traders are basically weather forecasters, but the weather is geopolitical tension with a chance of gasoline.
Simple finance version. Oil is a global input. When crude rises, transport and manufacturing costs rise, and that can bleed into inflation. Even if you don't buy oil, you buy things that ride on oil.
So my online shopping cart is basically a tiny oil derivative. Cute.
Now the Fed angle. The feed item, Chicago Fed President Goolsby called for a hold on cuts because the current pace of inflation is not good enough. That's a clear message. They want more evidence inflation is trending down before easing policy.
The Fed is like a parent in the car saying, "We are not stopping for rate cuts until inflation behaves." And the economy in the backseat is screaming.
Why it matters: if cuts are delayed, borrowing costs can stay higher for longer. Mortgages, auto loans, and credit cards. The flip side is savings yields may remain relatively attractive, so cash management actually matters.
So my to-do list is, don't panic trade tariffs, don't worship one earnings report, assume oil can mess with prices, and treat my cash like it's finally employed.
That's the episode. Quick recap: tariffs add uncertainty and margin pressure. Nvidia earnings are a read-through on AI demand and supply. Oil near highs can feed inflation, and the Fed is signaling patience on cuts. If you got value, subscribe and share BD Daily Finance News Podcast. Same time tomorrow.
And if your portfolio is feeling haunted, remember, you don't need an exorcist. You need diversification and maybe fewer push notifications. See you tomorrow.